The information in this podcast is current on the day of recording. It is general advice only and does not take your personal situation into account. It may not be suitable for you.
Welcome to Stocktake. My name's Gaurav Sodhi. Joining me today is analyst Graham Whitcomb. Hey, Graham.
Hey, Gaurav.
And with us also is our founder and editor, John Addis. Hello, John.
Morning, Gaurav, Graham. Let's do that again, right? Ready? Morning, Gaurav. Morning, Graham.
There we
Morning,
go.
John.
There we go. We can fix that in post anyway. We can fix anything in post. We can say whatever we like and it can all be stitched together later on. Don't you worry about it. Now, boys, we've got a bit of a EV special today. I'm going to be talking a little bit about lithium and Pilbara minerals in particular. Then Graham, really keen to hear about Waypoint REIT, which is a owner of potentially EV stations, but at the moment petrol stations. And John,
Hey, it just occurred to me that they're kind of a hedge. You're betting on one against the other, or at least some people would think so.
I wonder which way that will go. We'll get to that. That's quite interesting. And John, this is a topic we've discussed internally a lot, so looking forward to your feedback as well. But let's begin with, I guess, where the boom has begun, which is with lithium. Now, I would say about 12 months ago, or even longer than that, maybe 18 months ago, we were getting so many questions about lithium. And the questions weren't so much, can you explain lithium? Why is this price moving? It was, why aren't you recommending or covering lithium stocks? These companies are all booming. The price is booming. Why are you missing out? And it's not uncommon to get those sort of questions and those sort of demands from people. And often when we get them, it's a fantastic signal that the market is at a feverish, bubbly, euphoric high. And I will say that I'm getting them now about uranium as well, getting a lot of comment about uranium. Why aren't you covering uranium stocks? Are you going to be covering uranium stocks? Platinum has doubled. Don't you know the world's going to run on uranium? All this certainty comes in with the confidence of higher share prices. And what we're seeing with uranium today is an echo of what we saw with lithium last year. And a lot of these booms end in the same way, with steeply falling share prices and sagging enthusiasm. And that leads us neatly to where lithium is today. Processed lithium prices have fallen about 80% over the last 12 months. Lithium concentrate prices, which is a intermediate product before you get to the battery grade material, that's what most miners produce, a concentrate. They've fallen about 50-60%. And so share prices have fallen, not as much as that, but they have fallen a long way. No longer get questions about lithium companies anymore. And the most shorted stock on the entire ASX is Pilbara Minerals, which is the largest pure play lithium business on the ASX and possibly in the world.
Two good counterintuitive indicators there, I think.
Yeah, I think so. And look, I don't mean to sort of, I'm not having a go at people who are asking questions. This is a natural curiosity. I think the point I'm making is that the market gets carried away at the top and things that are rising just garner so much interest. And share prices is what feed enthusiasm. And when share prices fall, that's what leads to neglect, and neglect leads to opportunity. So what you want to do as a contrarian investor is to try and fight the urge to buy things when they're hot and everyone's looking at them and everyone's excited about them, and then come back to them when people aren't looking at them and when there's less enthusiasm about them. And that's what we've done with lithium, and that's what we're doing with Pilbara Minerals. Pilbara Minerals is now an interesting business to look at. And I think it's actually one of the best hard rock lithium assets in the world, and it appears to be very reasonably priced. The very curious thing about this, gentlemen, is that 15% of the equity is being short sold, by far the largest short position on the ASX. Yet this company has 30% of its market share in cash. It's not something you see.
Yeah, just crazy. Yeah.
Yes.
I remember
seeing
that. Yeah, I agree. I remember James Carlisle explaining it once and being like, he's not afraid of heavily shorted stocks because you've got guaranteed buyers there. At some point, these guys have to buy the stock back.
No, that's a good adapt. Yeah, I did think about
And
like
yeah,
that. But
especially when you've got one that's loaded with cash, the company itself could be the buyer. It could just be buying back the stock. So it's quite a pool of buyers on the sideline right now, but they're there.
and it's instructive to think about what the shorters are doing. Often short sellers, they can be short-sighted, but they're often the most hard-edged, best researched, most knowledgeable investors in the market. Think about the famous short sellers, the Jim Chanos's in the world, the John Hemptons. Have you ever heard these guys speak and talk about stuff they're short on? They're not always right, but they are very well informed. And so I always pay attention. Well, they're taking an impossible bet. They're taking a silly bet, really. You're right. They've got a lot more to lose. And when they're going public, they have all their reputation to lose as well. So it's worthwhile asking, like, what are the short sellers doing, selling so much of this stock short? And I think the answer is that there's a negativity around lithium at the moment. And the best way to express that negativity is by shorting Pilbara in particular. There are other ASX miners who are short quite a lot, lithium miners who are short quite a lot, but nothing is as liquid and as large as Pilbara. The other two big ASX lithium miners are Independence Group and MinRes, and both of those have lithium exposures that are diluted by other businesses. So it's not quite the best way to express a view on lithium, whereas Pilbara has the second largest hard rock mine in the world, and all its earnings come from lithium sales. And if you want to bet on lower lithium prices, this is the opportune way to do it. So I think what we're seeing in that short position is the market consensus view on lithium prices, that they're going to fall or at least stay weak for a while.
That's an interesting point you make about the other lithium businesses out there being kind of diluted by other things, because then it could be that the shorting of Pilbara is actually people trying to go long whatever those other parts of the businesses are, but they don't want any exposure to lithium, so they're shorting Pilbara to get rid of that portion of the exposure. So it might be nothing to do with lithium, really. It could be neutrality towards lithium that's causing it to be shorted so much.
Yeah, it's a good point. That's known as a pairs trade, and Pilbara is a perfect pairs trade because it is exclusively lithium, when exclusively lithium is hard to get. So I'm sure there's quite a bit of that going on as well.
Does any of this relate to demand for lithium?
Yes, it does. In the largest market for lithium is China, which has the world's largest sales of EVs, and sales there appear to have fallen off a cliff. And that has a lot to do with cyclicality inside the Chinese domestic market. The Chinese economy is really struggling, and it looks like consumers had brought forward lithium EV sales in the last few years, and those sales have fallen away quite dramatically. So it's, I think the right view is that lithium ought to be cheaper now than it was before, and it probably will stay cheaper for a little while longer. But every time we get these kind of big swings in prices, we need to ask ourselves, is this cyclical or is it structural? Do we look through this, or is this a permanent state of affairs? And I think when it comes to lithium, we've made the case before that the metal's going from being a very niche mining commodity to being a bulk mining commodity. It has to attract a whole bunch of capital, and it will only attract that capital if prices stay above marginal cost for a long time. And that's happened with other commodities, most notably iron ore over the last decade. So I think there's a good chance we'll see that with lithium. So I'm quite happy to look through the current weakness, and with the proviso that it may last longer than many people think. So what you really want to do is find a lithium business with a bulletproof balance sheet, with a operation that's been proven, and with a path to production growth, I think. And all those things are evident in Pilbara.
I've got a few questions on Pilbara and lithium in general. So excuse my ignorance for this, Gaurav, but I'll just pose a question about lithium and its centrality to the battery industry. Lithium batteries have been around for a long, long time. Only now are they really gaining kind of wide-scale adoption. is there a risk that the money coming into battery technology at large means that there could be a switch to a different kind of battery technology that moves away from lithium?
Yes, I think that is a risk. And I think where you'll see it, lithium has a lot of benefits, but also has a lot of trade-offs. As a piece of chemistry, lithium is both extremely light, it's the lightest metal, but it's also the most reactive. And that makes it really good for mobile batteries, which means batteries that kind of need to be light and very powerful, perfect for things like consumer electronics, and really useful for things like cars, where you want really dense amount of energy in the lightest possible packaging. But if you're thinking about batteries for backup storage, for power generation, or for homes, you don't really need lithium. So I think we're going to see a more diverse set of chemistries for batteries, where consumer electronics and possibly certainly high-end cars are going to maintain expensive lithium chemistries. Cheaper cars are probably going to use more heavy and less energy dense chemistries that may not require as much lithium. And I think there's, in my view, the backup storage for industry, for homes, and for generation, there's no reason you can't use a much cheaper, less energy dense method of storage, where you probably don't need a lot of lithium. You can use lots of other chemistries that are available, much cheaper to manufacture, and don't require all the fancy packaging you get with lithium.
So is any of that related to the fall in price, or was that all just kind of bubble irrationality? Or is there something going on apart from China? Is there anything else in there where there are concerns being expressed about a switch to a different kind of technology that involves less lithium?
Well, I think we were in a lithium bubble. I look at where lithium prices were, and it was just insane. Just for some reference, the lowest cost producer of hard rock lithium in the world comes from Greenbushes. They produce at a cash cost of about $200 a ton. Lithium was going for $8,000 a ton, US dollars a ton. Greenbushes was making 90% EBITDA margins, made $10 billion of profit last year. But the prices were just too high because people weren't considering these nuances about changing lithium chemistries, cyclicality and demand. These things were being thrown out. The nuances were being thrown out under the strength of the overall narrative. And that's why I had no desire to buy lithium companies in that sort of environment, because it felt frothy and it proved to be a bubble. But every bubble is built on a kernel of truth, and there is some truth to what the cheerers of lithium were saying. And now's the time to revisit that when prices have collapsed.
So what's the specific attractions of Pilbara then compared to any other lithium company around the world? Well, what is it about that's got your attention and made you interested?
Well, I'm interested in hard rock lithium, spodumene, as opposed to brines. I just think the risks, especially with permitting, with water access, and brines tend to be in less politically secure locations, whereas hard rock miners are mostly coming out of WA, and WA is the best mining jurisdiction in the world. So I've been I've exclusively interested in hard rock miners, and there are two great mines in the world. One is Greenbushes, which has a diabolical ownership structure split between 4 countries over 3 continents, and IGO owns 25% of that mine, but it's a non-controlling stake, and it is a very good asset, but it is not 100% owned, and they don't have control over it. The second best hard rock mine is Pilgangoora, which is Pilbara's primary asset. And what makes it fantastic is that it's extremely shallow, so you can actually dig and get great economics. The grades are reasonable without being spectacular, but just the sheer tonnage, this thing is a monster. It is huge, and haven't reached the edge of the ore body. It's so large they've stopped drilling to see how big it is, because they have so many decades of resources. They don't need to drill any further. But there's no doubt that this thing can get bigger and bigger. And the other thing that's really attractive about it is that it's been in production for 2018, about 4 or 5 years now, and it's taken that long, 4 or 5 years, for them to figure out the geology and the chemistry to produce the concentrate. They had a lot of teething issues. Building a new mine in a new industry is difficult, and you have to give companies a bit of room to figure out how to do it efficiently. And it looks to me as though Pilbara has figured out their geology. They have worked out their chemistry. And so growth from here is really just about replicating what they already know. You don't have to fiddle around with trying to experiment. They had the good fortune of doing that when lithium prices were at all-time record highs. So they could afford to make errors, which they did. They could afford to experiment, which they did. And they could do that without risking the business. So there was a lot of luck involved in the success of Pilbara, but having a fantastic deposit is just is the basis of the success of that company.
So the company's over the hump then in terms of production and technology. In our Monday morning meeting, you raved about management a fair bit too, or I took it as that. You seem to be quite impressed by them. Yeah,
I mean, I acknowledge that the success of Pilbara owes a lot to luck. I don't think in a weaker price environment they would never have gotten up and going. They needed a lot of debt, they needed a lot of equity, and they wouldn't have got access to that capital without the strong narrative of lithium prices higher for longer.
Kind of like Fortescue in a way then.
A lot like Fortescue. Yes, got lucky with the timing, but you need that in business. You need to be lucky. But they also took advantage of opportunities when they came up. So in 2015 or so, 2014, 2015, somewhere around there, lithium prices were on their knees. Lithium producers were completely neglected. They couldn't really access a lot of capital, and lithium producers were falling all over the place. The tenement that they had was shared with another business called Altura Mining. Altura Mining went bust, and even though Pilbara had no money and a lot of debt, they still put their hands up and bought the neighboring property out, because they knew it would mean that they controlled the entire Pilgangoora asset, and it just would make sense for them in the future, even though it imperiled the company at that point. And at that point, there was a bit of surprise, there was outrage, there was protest that they were taking on, imperiling the balance sheet and risking the company really to make this acquisition at the worst possible time. But I would say that, which they were, and all of that, I would have been, if I was a shareholder, I would have made all those same. Raised all those same concerns. I would have had the same view that this is a mistake. You're risking the entire business on this acquisition. But that acquisition was what has made Pilbara the success it has been. It is the consolidation of the tenement lease. It's them taking a risk, putting everything on the line. And these guys.
You want to back a management that does behave that way, even if they turned out lucky?
Yeah. I think, well, They took the risk when it was worth taking the risk. And over the last few years, they've been sitting on really high margins and a huge pile of cash, and they've shown discipline when it was time to show discipline. And that's what I want. I don't want a management that isn't prepared to take a risk. I don't think that serves anyone's purpose. But certainly not in this industry.
No, is that you want them to take the risk once, but you kind of don't want them to do it again.
That's right. That's right. That's what makes this tricky, right? You want them to take it. Well, you want them to take it when they need to take it, and understand when they don't need to take it.
You want them to take it when it works.
Yeah.
Without that bet, the company would not have been the success it is today. And as I said, there's a lot of luck involved here. I mean, in hindsight, that could have turned out to be a company wrecking decision. But as a new shareholder,
better lucky than smart.
Better lucky than smart. I've put that on a t-shirt, sell it. That's my motto in mining. Better lucky than smart. I mean, there's so much variability in this industry. You have to acknowledge the variability, and you take luck over smarts any day of the week. I mean, think about think about Fortescue, right? A $60 billion business, the only new iron ore miner in 60, 70 years. And they had maybe a 2-3 year window where they made that happen. It couldn't have happened at any other time over the last 100 years. And it couldn't have happened if the CEO founder was a sensible, conservative figure. It only happened because he's a mad dreamer. And that's the kind of person you need when you're building a mining business. But then you need to pivot to be a sensible CEO after you've got all your assets and a lot to lose.
We try.
And for me, Pilbara has shown both the initial craziness and the subsequent pivot.
So that research should be up on the site by the time members hear this.
Yeah, should be. A bit nervous about promising that, but yes, it should be.
You've got another 24 hours.
24 hours to do it. That's right. Thank you for that. Thanks for the reminder. We should chug along then. I want to go from the raw materials, Graham, to another part of the value chain.
The company who hates them most.
Well, maybe might benefit from them, maybe not. It's a bit early to say, but tell us a little bit about Waypoint REIT and why this one has been giving you so much pain.
Well, it hasn't given much pain, but it's an interesting company. It owns 400 or so service stations, mainly the Shell network along the East Coast. And so, yeah, it's a huge beneficiary of the oil economy and of cars that are petrol powered. It doesn't really want electric vehicles on the road because every electric vehicle sold is someone who's not buying petrol. Yeah. But I mean, there's also opportunities for it as the kind of car fleet electrifies. And yeah, different members were pointing out how they're in the comments section, how their mindset changed with electric vehicles and how they still go to the charging stations at these places, and maybe because the charging takes so long that they'll be forced to spend longer at the service station, which then I don't know, I can imagine a situation where it turns out a bit like airports where people are there plugging in and then having to wander around the shops for an hour. It won't be exactly like that for charging stations, and I think it's such a slow kind of turnover of the fleet anyway that it's going to take 20 years before there's before it becomes really dramatically obvious that there's just not as many petrol powered cars on the road. I think there's a long runway for Waypoint to adapt, and it owns all the properties outright, so it can update them, it can repurpose them. I mean, these are the corner blocks in all the capital cities. They're a fantastic group of real estate. It doesn't have to stay as a petrol station over the long term. A lot of developers would love to get their hands on them.
Yeah. I like that there's a natural hedge in there as well, because if they lose revenue because of electric cars, then surely the value of these properties goes up because of electric cars, because they on very busy intersections. And when you remove the noise discount that comes from combustion engines, you must get an uplift in the price of the property, surely.
Yeah, probably. And I think people also don't realize that most of a petrol station's income isn't from petrol. It's from all of the high margin snacks and drinks that go in the shop. So because petrol itself is just a commodity, it's so low margin for these businesses that, I mean, if petrol sales go down 10%, it's not going to make that big a difference to what's it called, DeViva, like the main tenant of Waypoint. And even then, Waypoint has a fixed rental contract, so it's even less exposed to petrol sales.
It's the first time we've had a recommendation like this in a long time, something genuinely good for income investors, I feel. Yeah. That makes me interested. I know that you can go and get 5%, 5.5% on your money now, but this is at 7.4% unfranked, I think, and it's trading at less than NTA, and it's a question of whether those book values hold up or not, and you've addressed that in your recent piece of research.
The main risk to it is interest rates. That if interest rates kept on rising from here, it does have quite a bit of debt, And so that could anchor the growth in dividend by quite a lot. The rental leases themselves have a built-in kind of 3% escalator for most of the portfolio. So you can pretty much, all things being equal, you can take the dividend yield and add that 3%, and that's probably what your total return will be kind of in the medium term anyway.
Yeah.
But interest rates are a big swing factor. So yeah, if you're buying the stock today, you are getting it at a discount to tangible assets, you're getting a decent yield. But if those interest rates go up another couple of percent, then that's not going to look as attractive after that. So there's some risk there as well. It's not a bank account.
In terms of commercial property, Graham, do you feel as though this is trading below NTA because there's just widespread suspicion about what commercial properties are on the books, the value of them on the books? Or do you feel as though it's something specific more to the kind of discussion that we had in the comment section about the transition to an electrical vehicle fleet and what that might mean for the revenues when you have less visitors coming into the shops, which is really what they are?
Yeah, I think it's probably more the latter than some sort of view on commercial property. Yeah, I think that the EV thing probably does have an impact on it. And there's also a lot of investors and funds that just can't own fuel stations. So I think there's a slight advantage there to those who can, And also, I think there's a bit of a bet on it that it is a very interest rate exposed stock. So any funds or investors who are wanting to bet against interest rates, that's a pretty natural stock to own, I think. So yeah, there's risk to owning it. It's not some sort of bulletproof company, but you're being compensated for those risks as well. You're getting a pretty good yield. You're getting locked in growth, excluding the interest rate effect, and you're getting the stock at a discount to its property values. And the property values are pretty fairly priced, I think. This isn't one of those REITs that has got, I don't know, all these outlandish claims around the appraisals. The properties seem fairly priced to me. So I think that there is a genuine discount to what they're worth.
Yeah. And there's a backstop there as well with the, if you were to turn the land value over and just put apartments or commercial office blocks in there seems to be a backstop there that doesn't exist in many of these kind of situations.
Yeah, that's how I look at it too, is if you're owning an office block, you don't have as many options as you do owning a decent sized corner block in a capital city. I mean, if you just think about where these are located, because you've probably driven past one today if you've been on the road, they're all the best real estate on every street. So even if they're not service stations at some point, once you get through the remediation costs of the land, because they do take a couple of years to rehabilitate the soil and to get the tanks out and all of that.
Yeah.
But once you've done that, these are wonderful blocks of land. So yeah, the company, I think there'd be enough of a gradual shift towards electric vehicles, if that is an effect in the long term, that diminishes the rentability of these service stations. Once you get through that remediation cost, I think that all the value is actually there. There's certainly a large discount at the moment, which more than takes into account that remediation cost.
Yeah. The other thing I'll add, sorry, John. The other thing I'll add is that the disruption here is not like disruption in, say, traditional media or newspapers, where the legacy guys were just completely in denial and blind to it and let the new technology just walk all over them. You didn't even react to it, right? Just a complete failure of management and imagination. Here, Viva, I don't know as well, Graham, but I do know Ampol very well. Ampol has been very alert to the threat, and they have changed their business model quite a lot to adapt to the world that's quite slowly being presented to them. So these businesses are changing and evolving to meet the disruption. They're not in denial, which is what we see sometimes with the disrupted industries.
Yeah, and it just can't happen as quickly. You cannot replace all the cars on the road overnight. This is going to take decades to actually get through. So, I mean, that gives them a lot of time planning. By the time this is through, we're probably going to be 5 CEOs into the future. So there's going to be plenty of plans and strategy changes along the way. But what you've got the whole way are great blocks of land. And so all the rest of it is just kind of the current use. But in the long term, you've got 2 million square meters of prime real estate, basically. It can be changed.
Yeah. Just a couple of comments from me, Graham. Firstly, your costs that you wrote in the article about the remediation costs when you buy a petrol station, that accords with my experience. I actually looked at buying a petrol station about 8-9 years ago. And it was going to cost about 800 to $1 million to fix it up. But the land was huge. So that accords with my experience, my personal experience. And the second thing, just to comment on how members might want to think about this. It sounds strange, but it's a question for you really, Graham. When I think about you go and buy the fuel and you make the money on the chocolate bars and whatever else you sell in the other drinks, it's kind of like cinemas in that respect. But cinemas have adapted too, in the way that Graham was saying that Ampol have adapted in their food stores. You know, you get different kinds of experiences. You can get seats where the arms go up and you can rest easily, and you can get waitress services in the cinemas. And there's an adaptation there to what really is a commodity product to ensure that revenue stream in the cinemas keeps on coming. And I kind of think of this situation like that when I read your article. That's what I thought of. Do you think that comparison holds up?
Yeah, I do. I think that you're buying more in this business than almost any other REIT. You're buying locations, and those locations can evolve over time. But the good thing about Waypoint is that it's got these fixed rents in the meantime. So all that adaptation is happening in the background. The electric vehicle revolution and all of that is a bigger effect to Viva, its primary tenant, than it is to Waypoint. Waypoint has a long horizon to manage this, to change its portfolio, to sell underperforming sites, or to adapt them and change their use. It wouldn't totally surprise me if the company eventually evolves into some sort of property developer for its own properties. It's got this huge land bank, and it's not written in some constitution that it has to always be service stations. So I wouldn't be surprised if it evolves over time and we come back 10 years or 20 years from now, it's turned out to be this commercial property developer.
That was going to be sorry, go on, John. I was going to...
just one final point is that one thing you didn't mention there, Graham, is that even if the transition happens really, really slowly and maybe doesn't go as well as we hope, there is the fact that we're going to have 40-odd million people in this country by 2060 or 2050, whenever it is. Most of them are going to go Sydney and Melbourne. There's a lot of population growth. There's bipartisan support for this across the political parties. That surely is a bit of an offset as well. There's a bit of a backstop there too in population growth.
And there won't be any
benefit from dense.
No.
Yeah, exactly. It'll benefit from that densification either way. So, yeah.
I liked your cinema comparison. I had never thought about that, but that makes a lot of sense to me. I quite like it. The other way I was thinking about it was as a land banking operation. It reminded me a little bit of Brickworks, where the idea is just to own a whole bunch of land and hold it for a long time. You just put a business on the land to sort of pay the costs of holding the land and pay a CPI linked return. But the value here is just in the land over time. And
that's how I see it as well.
Yeah. Land banking is a wonderful business model, and it's worked really well for Brickworks, and that's the way I would view this one as well. Yeah.
Would you like to own the corner block of the main streets in Sydney and Melbourne?
Yep.
It's that simple, the question.
Yes, and, yes, you're right.
Yeah, all the rest is stuff.
Importantly, that question completely removes petrols and EVs. I think you're 100% right.
Yeah.
That is the central question, yeah.
If you like the sound of our investing approach but you're not yet a member, visit intelligentinvestor.com.au and take a free 15-day test drive of our membership. You'll get immediate access to all our current buy recommendations, model portfolios, and engaging educational research, tailor-made for people who want to manage their own money. That's intelligentinvestor.com.au for a free 15-day trial. No credit card required.
Gents, we've got an interesting question that came through on the comments. It's probably worth thinking about that a little bit now. John, do you want to just introduce that question and we'll have a go at answering it as best we can? It's a long and detailed one.
It's a long one. I won't recite it because I haven't got the energy this morning. But essentially, it's about using traditional value-based financial metrics, return on capital, return on equity, to eliminate poorly performing businesses over time and just look at those high-quality businesses that perform well on those kinds of metrics, general value investing-based metrics, and wait for opportunities to buy those stocks when they're going through a difficult period. Why don't we do more of that? And I think the comment was that while we're trying to work out the future in companies like Waypoint REIT and Pilbara, that is a more difficult thing than simply buying high-quality companies like Cochlear and CSL when they're going through a difficult period, who have got these amazing financial metrics over sometimes decades. Why don't we do more of that rather than the kind of stuff that we've just been talking about? Because it's probably a more secure and more reliable way to make money over time.
I have a problem with that, actually. I really don't like that method. I think it's wrong in theory and is wrong in practice. Why is it wrong in theory? Because if all you're doing is going through easily available, easily calculatable, easy to calculate financial metrics, like someone with a bit of skill could write an algorithm in 3 minutes to do that. You don't need to think. It's been that sort of advantage was what you had, I think, 20 or 30 years ago, before the rise of computer trading. But you can't do that anymore. You can't just go through and pick out a bunch of financial metrics and think you found a great investment. It doesn't work that way.
I'll be the de facto member then and just address that. So, well, if you look at a company like ResMed, which probably has exceptional metrics like that, well, I'm sure it does, and is now going through a bad time, we would use those metrics to try and determine our action and say, this is a high-quality business, it's going through a difficult period, this is the time to buy. And that's what we've done.
I think it is what we kind of do to some extent.
Kind of do that stuff.
Yeah.
What we don't do is publish those metrics in the research. We all know them, but they don't tend to get much of a run in the research. So we do have our list of high-quality businesses that are on the top 10 businesses list, and we do tend to buy them. And I think ResMed, CSL, some of your stocks, Graham, we recommended lately are examples of doing exactly that. What we don't do is connect that back to the actual metrics that this member raised with us.
We also don't do it mechanically. That's a big difference. Is that we're not just running screens and then doing that. Because all of those things are just looking at the history of the company, when what matters is what happens in the future. So you can't do it mechanically, but there are things that we think about. We certainly notice a company that has above average returns on equity or capital over.
But that's the starting point. That's not the end point, right?
Exactly.
That's what makes you do your research and think about the business. That's not where you reach your decision point. You don't find a business with high ROE and then think, oh, this has high ROE, let's buy it. You find that business, then you think about, okay, what generates these returns, and is that sustainable? And is the problem today that's providing the opportunity, a la ResMed, is that going to influence those returns in the future? Those are the hard questions to answer, and that's what algorithms can't do. I might give you a few examples, right? So think about something like Lend-Lease, which for a long time was a blue chip business. When I was learning investing in the 90s, and Lend-Lease was the bluest of blue chips. It was the Macquarie group of today. Everyone had it in their portfolio. You never got in trouble for buying it. Really fantastic financial metrics. And that's just been a disaster for 20 years. And the history of great financial metrics just meant nothing and disintegrated. Iris today is another one. It's got fantastic historic metrics, but it's a basket case. Computershare, another one, hasn't gone anywhere for 10 years. Fantastic historic metrics. I just don't think fancy historic metrics mean all that much when you're confronted with a changing world.
Yeah, there's no doubt about it.
And very often they just lead to, I mean, if they're obvious to everyone, then that's kind of priced in. So
it's priced in,
yeah.
I mean, there is a balance there. I wouldn't discount history altogether. I mean, how a business has behaved over a long period of time tells you something, but it's a very small piece of the puzzle. It doesn't provide an answer.
And as Graham said, if you're going to get a chance to buy it, you're going to get a chance to buy it because people think maybe there are cracks in the story that delivered those metrics over time.
Yeah, that's right.
And you have to make a judgment, as we've just done with Waypoint and Pilbara, about what that future looks like. So you still have to make a call on how you think things are going to play out in the future, having used the past maybe as a filter to find out what are the high quality businesses in Australia. But we could all sort of reel those off anyway, and I think most members could too.
Yeah.
You can apply a filter to Iris and see these companies, and they're all going to be on the top 10 businesses list. We know what they are.
Yeah.
It's just a question of whether the opportunity to buy them is a good one or not. And to make that choice, you have to assess the future. You have to make a call on what that future might look like.
I remember reading one fund manager saying, it was Kurt Nelson actually, it was Ken Nelson. He was saying that businesses typically have like a 20-year life. They have 20 years to make returns, and after that, they sort of fall, and something else rises to take their place. And that's kind of an interesting way to think about it as well. When you think about how many companies have actually generated great returns for more than 20 years, it's
not many.
Small group of stocks.
Yeah.
Right. Well, we've been going for 50 minutes, gents. I think we had a few more things to talk about. I might park those for next time.
Sure.
And this might be a good time to call it. Graham, anything else to add, or can we sign off?
Nope. Free to leave early March.
Free to leave. Wonderful. Okay. Well, thanks for your time today, Graham. Thanks for joining us.
Thanks, Gaurav.
And John, thanks for not standing up, and thank you for your time today as well.
That might be my departing gesture.
And for everyone else, quick, stop and turn off. Thanks for listening.
Thanks, Gaurav.